Okay, when doing fundamental analysis, there are two important concepts. First would be earnings. Second is valuation. The science of fundamental analysis is a combination of both quantitative and qualitative analysis to determine a stock's value by focusing on a company's actual business and its future prospects. Okay, so we have to actually learn more about the company's earnings prospects and how it's being valued by the market. Is this a proper valuation, or are we seeing upside potentials? Okay, so basically when you try to do fundamental analysis, you study all of these factors. I know there are a lot. You study the economy, you study the product that the company does. You try to learn as much as you can about the management of the company involved. What is the growth potential of this company in light of its products and the management? How is the competitive environment? What is the competition doing? What are its future plans? Is it efficient? I mean, what are its strategies? I mean, these are questions you have to ask yourself. And then based on all of your studies, you do a computation of how much you think the company will earn going forward. And then you come out with a fair value estimate. And at the same time, you try to do a relative valuation methodology, or you compare its valuation with those of its peers to determine, whether or not the stock will make a good investment. So this is the science behind it. Okay, so just some quick to make it more concrete, because the concepts seem very abstract. You will notice how, for example, for Cebu Pacific, from year 2011 up to year 2014, you can notice how the share price, which is the blue line, has been going down or was in a downtrend. And you will notice as well how earnings have been on a downtrend during that same period. So what we just like to talk about is how earnings and share price are very much interrelated to each other. And this is something you would have been able to predict, assuming that you had studied factors that are affecting the earnings of Cebu Pacific. So from 2011 to 2014, the competitive environment of the airline industry was very intense. There was really a lot of overcapacity because aside from Cebu Pacific and Philippine Airlines, you had all the smaller players like Tiger Air, Air Asia, and a lot of those other smaller airlines who were operating at the same time, and there were price wars going on. So that really hurt the earnings of Cebu Pacific. At the same time, recall that during that period of time, oil prices were actually going up, exceeding $100 per barrel. So you had all those factors hurting the earnings in of Cebu Pacific. Therefore, share prices were also on a downtrend. However, come year 2014, the industry was consolidating. Both Philippine Airlines and Cebu Pacific were buying the competitors. Others just exited. And then, of course, we had oil prices collapsing. And those factors have actually allowed profits of Cebu Pacific to actually go up substantially. And as a result, Cebu Pacific share price have gone up. So as earnings went up, so did the share price. Now another example, we have Resorts World, RWM. You will see how the share price is on a downtrend. Earnings have also been going down due to intensifying competition from Solaire or Bloomberry. And then in 2014, 2015, you have the opening of City of Dreams. And then they're also hurt by the crackdown of VIP gamblers from China. So as earnings again went down, the red line, you will see how the share price also reacted negatively. Okay, then we have Ayala Land. you will see how this is actually a very attractive investment. It is a very attractive investment in light of how earnings have been on an uptrend from 2011 to 2015. Okay, the company disclosed a lot of positive developments. It's a strategic land bank acquisition, aggressive launches of properties, margin improvement initiatives, and brand building initiatives. And of course, the share price has followed, making it a very profitable investment for shareholders. Okay, and of course, if you had invested in the index, okay, our index has also performed very well. If you had bought funds starting 2006, your money would have actually grown 5 times from 1,500 to 7,500. And you can see how earnings of listed companies have also gone up quite substantially, benefiting from the favorable economic story of the Philippines. The Philippines is enjoying very strong economic growth thanks to country's favorable demographics, growing OFW remittances, stable or growing BPO jobs and revenues, and the low interest rate environment. Okay, so how do we develop expectations about companies, about listed stocks? We usually adopt a top-down approach. So first we try to study what's happening with the economy, and then after that we look at the different industries in the economy and try to do industry analysis. So when we do industry analysis, we study several factors such as the competitive environment, and aside from that, the bargaining power of suppliers, bargaining power of buyers, ease of entry and exit, and all of those other factors. We also try to determine what phase of the industry cycle the industry belongs to. So later we'll talk about it through an example. And then after which, assuming that we have identified an attractive industry, we try to study the different companies under it and try to identify which companies do we believe will be in the best position to take advantage of the favorable developments in a strong industry. Okay, so to make a more detailed analysis, for example, you have this question to yourself, should I buy Ayala Land? So using the top-down approach, okay, you try to determine whether the economic environment is favorable for property companies. So if you ask yourself, is GDP growth favorable for properties? So it's a yes, okay, because GDP growth is expected to be very positive. Then you have demographics. Demographics is also a positive for Ayala Land because in the Philippines, for example, our average age is 23 years old, meaning that people are just entering the workforce, their earnings capacity is still very high, and they're just entering the stage of forming families, getting married and having children. Then of course you also have factors such as the BPO sector, which is creating higher paying jobs, and of course interest rates are very low, which makes it very favorable or easy for people to buy housing at a more affordable cost. Yung hulog-hulog ba, yung which before you couldn't do because in the past, because interest rates are very high, it's either you had the cash to buy a property or you didn't buy any property at all. Okay, so going to the industry analysis, so the outlook for the economy is very positive for Ayala Land. However, in the industry, what's going on? So if we look at the different legs of the business of Ayala Land, the residential sector, there's a temporary oversupply, which is a bit negative for Ayala Land. However, the outlook for offices is still very positive because, of course, the BPO sector is still expanding in the country. And the outlook for hotels is also very positive because of the Duterte administration's focus on growing rural tourism in the country. So you try to ask yourself, is Ayala Land a good property company to capitalize on these opportunities and to mitigate the risk? Okay, so what are the positives going for Ayala Land? Okay, it has a big land bank, which is a plus. Okay, it has a strong balance sheet, meaning it doesn't have a lot of debts. So even if there's a temporary oversupply of residential properties, it should be able to overcome this challenge. Then finally, you look at its share of rental properties. Ayala Land has quite a bit of offices and malls. For example, it's one of the biggest mall operators in the Philippines, so it has quite a stable source of cash flow. So in light of what's going on in the country and in the industry, we believe that it is still a good company to buy, and earnings will still be on an uptrend despite the risk of a potential residential oversupply, at least in the short term. So you'll notice, for example, other stocks like in the past, Vistaland, when it was a 100% focus on residential, people had a negative view towards it because investors are concerned that the temporary oversupply of residential properties would hurt the company because it did not have a lot of rental properties. Okay, next, assuming that you're asking yourself, should I buy PLDT or Telephone? So again, the economic outlook is very positive for the country. Okay, however, if you look at the industry, it's not doing as well. The voice calls, revenues from voice calls are going down. This is because people are using telephones to make voice calls is diminishing. Again, as far as SMS is concerned or text messages, less people are using text messaging. They're actually using internet applications like Viber or WhatsApp to send messages. So the outlook for data is very positive. But let's look at PLDT. The negatives for PLDT is because of the large share of revenues from voice calls and text messages. So although it also has a data business, the large share of calls in SMS is a negative for PLDT. It's not in a position, it's not in the best position to take advantage of the ongoing trend in the industry where data is more popular. And another negative for PLDT is its capital expenditure requirement, because for it to be more active in data or to grow its data business, it has to actually spend more money. So this means that it will be able, it is less able to pay cash dividends, which is also a negative. At this point in time, a lot of us, people are very interested with their cash dividends. But then again, the likelihood of this cash dividends going down is very high because the company needs to spend on capital expenditures to expand its data business. So fundamentally, it doesn't look very attractive at this point. Okay, so the next thing I guess you would like to know is to determine how certain developments affect the market. Let's say you read the news in the paper and you try to ask yourself, how will this affect the stock that I own? Or how will this affect the stock market in general? So questions you may ask is, first, will this development hurt or benefit the economy? And after that, which industries will be affected by this development and which companies are the most sensitive? So we'll use an example for you to be able to understand this concept better. So how will the Duterte administration's plan to increase infrastructure spending affect the stock market? So using a top-down approach, you ask the question, how will it affect the economy? Okay, so an increase in infrastructure spending should have a favorable impact on economic growth because, of course, if you do the classic definition of GDP, which is consumer spending plus investments plus government spending and net exports, an increase in infra spending would push up both investments and government spending. So it is positive for the economy. Okay, and then what industries will benefit? Okay, definitely if you're going to spend more in infrastructure, you would need construction companies, cement companies, then also the other beneficiaries would be the banks, as companies doing more infrastructure investments would need to borrow money. And then, of course, the property companies, as the infrastructure around properties would lead to higher capital values for properties. Okay. And what are the stocks that would benefit? Of course, you would have companies like Metro Pacific that are heavily into infrastructure projects. And then you would have the contractors like EEI, Megawide, okay, then the banks, BDO, Metro Bank, and then properties, Ayala Land, SM Prime. So this is just an example of how you may want to analyze a news that comes out. So another example we have is, how will plans to impose excise taxes on sugary drinks affect the stock market? Okay. So impact on the GDP is a bit on the neutral side, not much to comment there. But if you look at the industries, definitely it will be negative for consumer companies because, of course, the selling price of sugary drinks like soft drinks, iced tea, even instant coffee would go up. And as you know, if prices of these products go up, the demand will be negatively affected. Okay. So who are the companies that have a lot of, who are the listed companies that have a lot of sugary drinks in their portfolio? You have Pepsi and URC, the makers of C2 and white coffee. So these companies would be hurt the most by this development. So that's how we do analysis of news that comes out on a daily basis. So now we can go to valuations. Okay. So by definition, the market price is equal to the current price of the stock, and the fair value is equal to the target price. And why is the fair value estimate important? Because it is a benchmark based on earnings and fundamentals. So earlier on, we talked about how earnings are important. But at the end of the day, the future earnings prospects of the company is reflected in one value, which is the fair value estimate. Okay, so there are two methods of getting the fair value estimate. And the first method is an absolute value method. Okay, you come up with an absolute value for the stock. Okay, so assuming that you did the computation, you came out with a fair value estimate of Jollibee of 215 pesos. So you can tell yourself, okay, I came out with this value of Jollibee in light of what I think it can do in the future. So I think I'll buy Jollibee if it trades below 215 peso per share. So it means that I'm buying it at a discount. On the other hand, if you do a relative valuation method, you will try to compare Jollibee to other listed stocks, say other consumer stocks. So you'll say, I'll just buy Jollibee if it's trading at a cheaper valuation relative to URC. So those are the methods, absolute method and relative. So we'll discuss this in more detail. Absolute valuation, one of the most commonly used method to value a company in absolute terms is the discounted cash flow. Okay. So this one of the advantage of the discounted cash flow is that it's most commonly used. If you talk to analysts from different brokerage firms or asset management companies, almost everybody, or actually everybody, understands this methodology. Everybody uses this for those practitioners. And specific assumptions can be made. You can assume, what if earnings go up by 10% and interest rates stay at current levels? Or what if, for example, the earnings, instead of growing by 10%, it grows by 15%? Okay, how will the share prices react? Or how will share prices react if interest rates go down further? So you have control over those variables, and then you can make assumptions and projections. Okay, the disadvantages, it is a very time-consuming process because you have to make so many computations before you can come out with the value for a particular stock, and it's very information heavy. Again, you have to make so many assumptions. You have so many variables when you do this method. Okay, so this is an example of how you do a discounted cash flow. So in general, the value of any asset in any company is determined by how much cash it can make over its life. Okay, so what you add the cash earnings for the different years for the rest of the life of the company. Okay, but that said, okay, so for example, you do this, you put 100 million in January 2015, put it in time deposit, and which earns 1.375%. In January of 2016, it's no longer 100 million. It's 101.375. Okay. So on the other hand, 101.375 in January 2016 is not the same in January of 2015. Okay, so it was only 100 million during the time. Okay, the concept here is that value of money today is not equal to the value of money in the future. Okay. Okay. So, for example, 100 million in 2015 is not the same as 100 million in 2016. What is the same is 100 million in 2015 and 101.375 million in 2016. For example, if you lend 100 million to your friend, of course, after 1 year, assuming that they will pay you back, you expect to earn a little bit more than 100 million because you actually could have made more putting your money in, say, time deposit, the opportunity cost of your money. Okay, so we also use that concept in valuing stocks. Again, earlier on, we had discussed how you add the earnings, or the value of a company is dependent on the cash earnings for the rest of its life. However, it's not enough for you to only add those earnings. You have to discount those earnings back to the present value. What is the value of those future earnings today? Okay, and that is going to be its present value. Okay, so fair value is equal to the value of the company on a per share basis. Okay. Okay, so when do you buy? When you use this discounted cash flow method or this absolute valuation method. And when do you sell? Okay, of course this one, the answer is very simple. If the market value is higher than the fair value, you sell. And if the market value is below the fair value that you estimate, then you buy the stock. Okay, on the other hand, you have the relative valuation methodology, which involves the PE ratio and the EPS growth, and the price to book value ratio, and the ROE, okay, or return on equity. So we'll talk about these technical terms one at a time, okay. So relative valuation involves the law of one price, okay. Identical assets should trade valuations or same prices, okay. The advantage is this methodology is easy to apply, okay, and it's very fast. For example, you're buying a property, and what you typically do is you look at traded price for that property, and then you relate it to your own property. It's actually very easy, especially for buying properties like condominiums in the same building. What you try to do is you look at the latest done deal of a similar type of condominium in your building, and you would know how much you may be able to sell your property for. Okay, so that's the advantage. It's easy. You don't have to do numerous computations anymore and different numerous assumptions. The disadvantage is comparables and multiples can be very subjective. Again, if you really think about it, it's different. It's hard to look for properties that are exactly the same, even for, say, condominium units in the same building, because one condominium unit might be better maintained compared to another one. Okay, the size might not be the same as well. Okay, so in some ways it can be very subjective as well. So those are the disadvantages. Okay, so here we have an example. So given, how do we compute for the EPS? Okay, oh, sorry, the PE ratio. Okay, the PE ratio is actually simply the ratio of the current price and the EPS. So looking at stock A, you have the current price of current price of 10 peso and an EPS of 1 peso for a PE of 10 times. On the other hand, you have stock B, which is trading at 100 pesos and the EPS is 50 pesos. So you have a PE of 2 times. Okay. So general rule for relative valuation, you prefer a stock that is trading at a lower PE. So in general, you try to buy a stock that is trading at a low PE. But sometimes this is not true. Actually, for PE ratios also, what is also important is EPS growth. Okay. So the limitation of relative valuation is also looking at a point in time. Because, for example, for stock A and stock A may seem expensive if you look at its PE because it's 10 times PE, while stock B is only doing 2 times PE. So at first glance, you would say stock B is cheaper, I'll buy stock B. But then, if you do further analysis, you'll see that maybe the reason why stock A is trading at 10 times PE is because its EPS growth is 100%, and stock B, there's 0% EPS growth. So in that respect, stock A may not be as expensive as it seems relative to stock B. Okay, just a general rule, stocks that have higher EPS growth will generally or can trade at a higher PE ratio. Okay, so how do we use what we know based on PE and EPS growth? Okay, so if we look at this example, what stock looks cheap? Okay, so here, if you look at this example, the stock with the lowest PE ratio is stock B. Okay, and it really does look cheap because if you look at the EPS growth, it is actually the fastest earnings growth. So which stock looks expensive? Okay, stock D looks expensive. This is because it is trading at the highest PE ratio, whereas its EPS growth is the slowest. What usually has to happen is stock B, which only trades at an 8 times PE, has to have the slowest EPS growth, whereas stock D, which has the highest PE, should have the highest EPS growth. Okay, so this is the PE ratio of consumer stocks that we cover and their EPS growth for 2017. Okay, so based on our computations, the consumer sector, as of last Friday, was trading at 24 times PE, and the average EPS growth is 9%. So what you could do is you could look for companies trading at or that have a higher EPS growth than 9% to see. So from there, you will notice that there are several stocks that have a faster EPS growth than the whole sector in general. So you'd have CIC, CNPF, DNL, JFC, P Gold, actually almost everything, Pepsi, RFM. So from there, which ones are trading below 24 times PE? So for those companies that have an EPS growth that is faster than 9%, you have CIC, CNPF, and then Pure Gold, and Pepsi, and RFM that are trading at lower PEs relative to the whole consumer sector. So you can say that these stocks look cheap based on a relative valuation methodology. So they might be attractive potential investments from a valuation perspective. Okay? And then for the conglomerates, you could actually do something similar. So you can check which companies have an EPS growth that's faster than 9%. So you have AEV, you have Costco, you have DMC, okay, First Holdings, GT Capital, LTG, and then you look at the the PE ratio. So which ones are trading at a PE ratio that is lower than 17 times? That also have EPS growth that are faster. So you have Costco, you have DMCI, you have First Holdings, okay, GT Cap. So from there, you will come out with a short list of stocks that look cheap based on relative valuation. Okay, then you have the price to book value and the return on equity or ROE. So the price to book value method is used in valuing banks because the assets of banks are already at market value. Because if you think about the bank, most of its assets would be cash and investments in bonds or loans that are payable at book value. Okay. So most companies' book value is not equal to the market value, okay, despite this concept. Okay, so what exactly is the book value? Book value is total assets less liabilities. Okay, so that would be the equity or net asset value or the book value. Okay, so this just means assuming that a bank closes shop, it sells all its assets and then it pays off its debts or its liabilities. What will be left is equity or net asset value or book value, and this is what is available for the shareholders. Okay, then just some definitions. Book value per share is just equity over the number of shares, and price to book value is the current price of the stock relative to this book value per share. And return on equity is net income relative to the stockholders' equity. Okay, and general rule is that relatively cheaper if the price to book value is lower. So in general, you would want to buy a stock that is trading at a low price to book value. However, a stock that has a higher return on equity justifies to be traded at higher price to book value. Okay, so these are the general rules in valuing companies using the price to book value ratio. Okay, So for this example, okay, which stock looks cheap? Okay, so you will notice here, for example, stock A, okay, yields an ROE of 15%. However, among the four, it is trading at the lowest price-to-book value ratio. Okay, on the other hand, which stock looks expensive? Stock C looks expensive because the return on equity is only 8%, but compared to the other three companies, its price-to-book value is the highest at 1.9 times. So relating it to our listed banks, okay, we can again use the same thing. The banks and financials, the average ROE is 11.9%. So we look for companies that yield ROEs which are higher than 11.9%. You have BDO, you have BPI, okay, and Union Bank. If you look at the price-to-book value ratios, BDO and BPI are trading at much higher price-to-book values, so they look fairly valued. You have Union Bank, which is trading below 1.7 times price-to-book value, despite its higher return on equity. So Union Bank looks like an attractive stock in terms of valuation. On the other hand, you might argue that Security Bank looks like an expensive stock because if you look at its return on equity, it's actually lower compared to the industry average, but it's trading at a much higher price-to-book value. Okay, so that is one way by which you may use the price-to-book value and return on equity. And then we have the dividend yield. So you may consider the dividend yield as a salary to you as an investor. So this is more suited for conservative investors. So we have some investors in the stock market who are after dividends when they buy stocks. But you have to remember, when you buy high dividend paying stocks, these are usually utility companies with slower earnings growth. So capital appreciation potential for these stocks might not be as attractive. You may be able to get your cash dividends, but in terms of capital appreciation, there might be very limited going forward. Dividend yield is defined as the dividend per share over the current price. Okay, so these are some companies that have high dividend yields. You have Meralco, Aboitiz Power, DMCI, Globe, and PLDT. So as discussed earlier, in general, utility companies yield the highest dividends or dividend yields. Okay. So when studying companies, where do you get information about the listed companies? You can go to the PSE website. When you go to the PSE website, you should look for company disclosures. For us as analysts, what is the most important is the 17A, which is the annual report, and the 17Q, which is the quarterly report. So they provide quarterly updates. I think the website for the PSE on disclosures is the PSE Edge. So you should go to the PSE Edge for the disclosures. Okay, then of course listed companies themselves would also have their own websites. Sometimes they would have more detailed disclosures there. And they have discussions, more in-depth discussions of what they do. Okay, so aside from what they disclose to the PSE, sometimes they also upload presentations, earnings presentations, which are more detailed compared to those that are available in the PSE website. Okay, and your stockbroker can also help you. Sometimes with all that detail from all the details you get from the PSE and the company website, you don't even know how to analyze it. Your stockbroker might be able to make more sense out of the information. So you would be able to get the views of your stockbroker's analysts through their websites. And of course, as discussed earlier, you have to be regularly updated by reading newspapers, reading news reports in the website to know what's happening to these companies. Okay, so these are just examples. Like earlier on, I talked about how you could get information from your stockbroker. So I work for COL Financial. Like for us, in the website, we would have our reports on different companies. Okay, and then we also have what we call our investment guide. So later I'll talk about our investment guide. We also come out with strategy reports. So on a semi-annual basis, we talk about issues that affected the market the past 6 months and our outlook for the next 6 to 12 months. Are we still positive on the market? Do we think it's going to go up, going to go down? What's the reason why we're still positive? Why are we negative? What do we think are the key risks? So we also have the calling the shots because the strategy reports are semi-annual. We have something a bit faster, which is the calling the shots. It's a monthly strategy report, and it's focused on the relevant issues for the month. And again, we have the company reports. These are more company specifics, company specific developments. Usually, at the very least, we talk about the earnings of the company on a quarterly basis. Usually, they make a lot of big announcements during their quarterly earnings reports. And we also talk about what we learned from our meetings with management, and if ever we do change our mind about the company, do we think the company deserves to trade at a higher valuation or at a lower valuation? And then, of course, we have our daily, weekly reports, okay, which summarizes both recent economic and company-specific news. And then again, the investment guide, which I talked about a while ago. For us, this contains the most important information on stocks in our coverage list. So essentially, the investment guide is a summary of everything. The important information that we have in this is that we have the current price of the stock, the levels that we think buy the stock, our recommendation on the stock, if it's a buy, sell, or a hold, and our fair value estimate. And then again, if you want to do your PE relative to EPS computations, we have that, or the price to book value and ROE computations, and the dividend yield, which I showed a while ago. So these are some pieces of information that would be available for you guys. Okay, so this is an example of our investment guide. I know it's quite small, but you can see how all the information is available there and how you could access it if you were a COL investor. So the next few slides, I'd like to talk about how you may be able to maximize the value of your stockbroker's research recommendations. Not necessarily COL Financial. You might be investing through other brokers. Okay, how do you actually go about picking a stock to buy? Okay, so step one, you could create a short list of stocks that you would want to buy. So what you could do is, given all the stocks that your broker is covering, you could list down all the stocks that have a buy rating and whose prices still provide an attractive capital appreciation potential. So you could list them all down. And then step two, diversify. Okay? So choose companies that belong to different sectors so that at least they don't move in the same way. Okay? For example, you may have many property stocks that have a buy rating and that have significant capital appreciation potential, but don't buy all property stocks. You should choose, say, a property stock, and then you should choose a bank, property stock, or then a power stock. So at least your portfolio is diversified. For example, right now, sentiment for mining companies is very poor. If you had all bought mining companies, then the sell-off of mining stocks would have hurt your portfolio significantly. If on the other hand, you own other types of stocks, then at least your portfolio would not have gone down as much if you had been concentrated on mining. Okay, so step 3, determine your preferences. Are you a growth investor? Are you a value investor, or are you an income investor? Do you prefer buying stocks which have high EPS growth? So you look at the EPS growth column and you pick the stock with the highest EPS. Or are you a value investor? Do you want a stock that provides a high capital appreciation potential, stock that trades at a low PE, low price to book? Or are you after the dividend? Do you want high dividend yielding stocks? So these are some of the things that you may look. Other things that you may consider would be liquidity. Are you an active investor or are you a passive investor? Do you like trading in and out of your stock all the time? If you're an active investor with a large portfolio, trading millions, we suggest that you go for larger market cap stocks so that it's easier for you to go in and out of the stock. On the other hand, if you're a long-term investor, you're just a buy and hold investor, you may actually opt to buy smaller market cap stocks, or at least you have the flexibility to buy smaller cap stocks because you will not need to go in and out of the position quickly in the short term. Or there are also some investors that are very particular about management. They are very particular about the names. Okay, you might want to look at who are the major shareholders. Is it Anaboitis, Anayala, the C family, the Kokongwei family, or MVP, or Andrew Tan? So, you know, you can pick the major shareholder who you believe will perform the best. Or, you know, certain brands that are familiar to you, that you have confidence in buying, like Jollibee, SM, Meralco. Okay, so just some closing thoughts for the investors. Be fearful when others are greedy, and greedy only when others are fearful. So I guess this is a reminder for all of us to be objective in our you know, decisions to buy and sell stocks. Let's be scientific and try to have an objective assessment of situations when we buy and sell stock, and not to be affected by our emotions. Okay. Okay, and we also try to encourage our investors to have a longer term thinking. Okay, because this table shows how stocks outperform all asset classes in the long term. As you can see, if you only hold on to stocks in 1 year, you can make as much as 67%, but you can also lose as much as 39%. But the moment it hits 10 years, you will notice how potential loss is actually less compared to bonds and T-bills, at 4% down versus bonds, which may lose 5%, and T-bills, which may lose 5%. Okay, when you reach 20 years, okay, you will notice how stocks are always up. Okay, and of course 30 years, it's always also up by around 11%. So stocks outperform all asset class in the long term, and chances of losses diminish significantly the longer you hold on to it. So that ends my presentation. So we're on social media, CUL Financial.